You're watching at France 24. Welcome to the business interview. I'm Markus Karlsson. If at first you don't succeed, try again. Once again, European leaders are under pressure to stem the Eurozone debt crisis. And 2012 has started with a flurry of diplomatic activity and a series of meetings between Eurozone leaders. And it's all leading up to another EU summit at the end of January. Where is all the talking taking us though? Well, to help us answer that question, I'm joined now from London by Martin Wolf. He's a chief economics commentator at the Financial Times, and he's seen as one of the world's most influential writers when it comes to economic matters. Welcome to the program, Martin Wolf.
I'm very happy to be with you.
Now, we're a couple of weeks into the new year. Do you think that we're getting any closer to a solution to the Eurozone debt crisis?
No, I think it would be wrong to say that we're really close to a solution, because so much has to happen to make it credible that this is all going to work out. But it seems plausible that we are close to a situation in which the crisis might be managed over the next year or so. One's beginning to see elements that together just might work to prevent things getting worse and therefore give countries on both sides, the creditor and debtor countries, a chance of working through the longer-term adjustments they need. And what I mean by the measures that have been taken, I think the most important by far are those of the European Central Bank, which does seem to have essentially committed itself to funding the European banking system, whatever it takes, however bad the collateral it has to take on. So I think it will relieve in very substantial measure the liquidity crisis. In the process of doing that for the banks, it may, though this is less clear, also relieve somewhat the liquidity crisis for some of the weak sovereigns, the most important, of course, being Italy and Spain. But in terms of the underlying adjustment problems and the creation of a new, stronger, more credible, more viable Eurozone, which is ultimately needed to guarantee and underpin confidence, I think we've still got a very, very long way to go. And underneath all this, there's still the Greek problem to resolve in relatively short order.
It sounds as if you're saying that we'll muddle through, that 2012 won't be the year when the Eurozone collapses. What do you think is the biggest downside risk?
It looks more likely.
What is the biggest downside risk? Is it Greece?
The downside risks are that the Greek position becomes unmanageable and Greece essentially leaves the Eurozone. That a deal is not done which is satisfactory, minimally satisfactory to the parties involved, and Greece leaves the Eurozone, and that triggers a crisis, a much more severe funding crisis for other vulnerable countries, and in that context, their problems also become unmanageable, both in their banking sector and their government debt, leading to possibly a sort of explosive chain reaction. In addition to that, of course, it is crucial that governments like that, above all those of Italy and Spain, are able to roll over their debt on a satisfactory terms. They look manageable. We're really not there yet. It's not clear that the ECB action is going to be sufficient to help. It's not clear that the funding will be there to help them. That's a second very big source of risk. I tend to assume at the moment that the third big source of risk, a real seizure of the entire funding of the European Eurozone banking system, will be avoided.
Now, I don't know about you, but I cover this story on a day-to-day basis, and I almost get the sense on a daily basis almost that it's Groundhog Day every day. I don't know if you get the same sense, but do you think that we'll still be talking about all of this in a year's time?
I would be astonished if we didn't. I mean, my own guess is that if it all goes well and the thing is ultimately sorted through in terms of the financing, the adjustment, and the underlying structural reforms, that the Eurozone cannot get through this crisis to a more fundamentally, enduringly stable basis in less than a decade. It's completely unrealistic to expect less than that. You have to understand the underlying structure as it was created was, in my view, this is not new, I've thought this for 20 years, defective. It has to be remedied. The divergence that has occurred in the economies is extreme. That has to be corrected. And the liquidity problems in the banking sector reflect underlying deep weaknesses in the Eurozone banking system, undercapitalization and so forth. That has to be corrected. And ultimately, a new political and economic compact has to be created. This is, if it's going to work, this is going to take a decade.
Now, you talked there about a stable basis. Surely part of that stable basis is more growth in the Eurozone, as it looks as if the Eurozone is hurtling towards a recession. What do you think the Eurozone leaders need to do to boost that growth?
Well, that is indeed one of the very, very big problems, and why I think muddling through, though plausible for a year, is not a long-term strategy, and it might even be unsustainable over that period. Ultimately, there has to be growth and adjustment. By that I mean that a restoration of competitiveness relatively in the vulnerable states, and growth therefore based on improved competitiveness, and there has to be growth in these economies to manage their debt, and that can't happen without rapid growth in demand in the core of the Eurozone and or a rapid improvement of the external balance of the Eurozone. The latter is really very difficult. Now, unfortunately, everything's going in the wrong direction. I believe that monetary policy by the ECB has in fact been too tight. The decision to raise rates last year was a huge error, and they're still being far too cautious on that. In addition, I can't see no case for further fiscal tightening in the core. On the contrary, we need more buoyant growth there. I don't think structural measures will do it over any relevant time horizon. Yes, there are big structural problems in Europe. They're not going to generate growth in the next few years. It is an underlying macroeconomic demand problem, which unfortunately the countries in the core don't accept. The fiscal rules they're increasingly moving towards are going to make this worse. So if you ask me, yes, we'll muddle through the next year, I think that's plausible. Is there an exit strategy that is shown here in terms of readjustment and growth for the Eurozone as a whole? At the moment, it isn't there. And that's very, very worrying. And I think that's what markets fear.
Now, I want to talk to you about something else now, and the bit of London that we see behind you there, the square mile, the City of London. And now, The Economist suggested in its edition last week that the City of London is under siege from British regulators as well as from European regulators, most of all, perhaps. Do you agree with that?
Well, I think it was a very good provocative leader, and like any good provocative leader, it exaggerated, but it recognized some important truths. And one has to understand the combination of forces. First of all, London benefited from an enormous explosion in financial activity associated with an enormous explosion of financial sector balance sheets, and that came to an end in 2008. So even if there were no re-regulation, there were none of the politics, the city is almost certainly will be looking at a worse decade in the next 10 years than in the previous 10 years. Indeed, the probability, it seems to me, that the Western financial system will shrink because it got too large. And that's not about anything other than fundamental economic forces. And it's an industry, if you like, that grew too much. And when industries grow too much, they have to shrink again. Over and above that, of course, there's been a regulatory backlash in the world, in Europe, and in the UK. Some of that seems to me utterly appropriate and sensible. I was myself involved in our independent commission on banking, which made some recommendations which would certainly lead to some shrinkage of the British banking system, which is just a small part of the city, I should stress, but an important part. Some of it is populist rage about the fact that bankers got away with it. I don't think that has been actually that damaging. I don't think the bonus tax in the UK, the higher income tax rates is a little more of a question. Is that crippling? And some of it does seem to me genuinely foolish. I think myself, I've never been persuaded of the case for the so-called Tobin tax, the transactions tax on financial activity. It seems to me a very bad sort of tax. It's not clearly what it's addressed at, and clearly that will be very damaging for the city if it were introduced on a European-wide basis. But actually, I don't expect that to happen. I'm sure the British government will veto it, and as a tax measure, I believe they will be able to do so. So I would say, yes, there are big problems, but most of it is inevitable, including even the regulatory backlash. The city has survived much worse. The city survived the Great Depression. It survived the Second World War. It'll survive this too.
But as you say, you were a member of the Independent Commission on Banking, which last year recommended that banks separate or ring-fence their retail banking arms from their investment banking arms. Doesn't that make you part of this alleged attack, though, on the city?
It may well be the case, though actually, if I remember correctly, The Economist in its leader actually commended those as relatively sensible proposals. Remember, our idea here was precisely to separate out the regulation of that part of our banking industry which provides normal day-to-day services to the British population on which they absolutely rely, the retail banking sector, making it strong, robust, well capitalized, to separate that from the investment banking activities of these institutions, which would then, we felt, operate in the normal rules of the global market, which of course might themselves be tightened. We actually think that's a basis for a sensible city, a city in which activities are not supported by taxpayers. It's clearly impossible, we felt, and I think there's an absolute consensus on that in this country pretty well. It's impossible, unconscionable for the general taxpayer to be seen to be backing investment banking activities in the city. And I personally think that the French government and the German government should really take the same view.
All right, Martin Wolf, thanks very much indeed for taking the time to speak to us. That was Martin Wolf, Chief Economics Commentator at the Financial Times. And with that, we're going to wrap up the program. Thanks for watching.